All right, let's get into it. Today's market had a real split personality. It was truly a tale of two massive and completely different shocks. You had this huge sigh of relief coming from the tech world, and at the same time, this sudden jolt from the US jobs market. So, we're going to break down exactly how these two powerful forces collided.
Yeah, the whole day's trading really boiled down to one single question, didn't it? How on earth do you balance a landmark legal victory for one of the biggest companies on the planet against a crystal clear sign that the economic engine is, well, cooling down fast? And the answer, as you might guess, was complicated.
Okay, so before we dive deep, let's just get the big picture. Here's the entire day's actions summed up in five key lines.
So, what we're looking at here is a classic split decision. No doubt about it. Big tech, Alphabet and Apple had a fantastic rally. But if you look a little closer, the broader market, the Dow Jones, yeah, it got left in the dust. And then you have these other signals, right? Bond yields cooled off, which is interesting. Gold surged to an all-time high, and let me tell you, that just screams that investors are getting nervous and running for safety. And to top it off, oil prices fell. So, yeah, a really mixed bag.
All right, let's talk about the single biggest story of the day. And that was Google's massive antitrust ruling. This thing sent a tidal wave of relief through all of Silicon Valley. This was the moment the entire tech sector was holding its breath for. The court ruled against the most severe penalties. What does that mean? It means Google avoids being forcibly broken up. And let's be super clear here. This outcome was so much better than what almost anyone was bracing for. A huge win. And this comparison right here really puts that massive sigh of relief into perspective. The nightmare scenario, the worst case fear, was that they'd be forced to sell off core parts of their empire, like the Chrome browser and the entire Android business. I mean, can you imagine? But instead, what happened? Their business model gets to stay intact. They just have to share some search data with rivals. It's like going from a potential amputation to just needing a Band-Aid. A huge difference. And the market's reaction? Wow, it was immediate and absolutely explosive. Alphabet stock just skyrocketed, up more than 9% to hit a new all-time high. I mean, that's exactly what happens when a massive, dark cloud of legal risk just, poof, vanishes into thin air. And, of course, Wall Street experts were right there to confirm this feeling. You've got analysts at JP Morgan calling it a clear victory. And hey, they didn't just talk the talk, they put their money where their mouth is, immediately bumping their price target from $232 all the way up to $260. That's a big vote of confidence. But here's the thing. This wasn't just a Google story, not by a long shot. This was also a massive, massive win for Apple. You know that incredibly lucrative deal where Google pays Apple more than $20 billion a year just to be the default search engine on the iPhone? Well, that deal is now safe. A huge revenue stream that was under threat is now secure. You can bet there was some sighs of relief in Cupertino, too. Okay, so that was shock number one. Now let's move on to the day's second major shock, and this one came straight from the US labor market. And let me tell you, this single piece of data completely flipped the script on what everyone expects from the Federal Reserve. So to really get this, we need to talk about something called the JOLTS report. I know, it's a bit of a wonky name, but what it measures is pretty simple. It's the Job Openings and Labor Turnover Survey, and it's basically the Federal Reserve's favorite way to take the temperature of the job market. It tells them how many jobs are actually open and available out there. Now, the key here isn't just that the number was low, it's the sheer size of the miss. I mean, just look at the massive gap between what the market was expecting and the actual number that came in. Just 7.18 million job openings. That's a post-pandemic low. This wasn't some gentle slowdown, folks. This was a sudden, sharp drop that suggests the job market is cooling off way, way faster than anyone thought. And check out what that one piece of data did to expectations for a rate cut. It's just wild. Before this report came out, a Fed rate cut in September was, a possibility, something people were talking about. After the report, the market is pricing in a 99.4% probability. I mean, that's as close to a sure thing as you can get. The data was so decisive that a September cut now feels like a done deal. And it wasn't just the market thinking this way. That sentiment was immediately echoed from inside the Fed itself. You had Fed Governor Christopher Waller, a really influential voice, come out and argue for what he called a preemptive cut. His logic? You can't wait around for the job market to completely break, because when things go bad, they can go south very, very quickly. But hold on a second, not everyone is on board with this idea. You've got economists like Claudio Irigoyen over at Bank of America waving a big old caution flag. He's basically saying this could be a huge policy mistake. And his argument is really interesting. He's asking, what if the problem isn't weak demand for workers? What if the problem is a sharp drop in the supply of people willing to work? Because if that's the case, cutting rates would just be like pouring gasoline on the inflation fire, a totally different problem. Okay, so we have our two main narratives for the day, right? On one hand, you have this massive relief for big tech. On the other, you have full-blown rate cut fever. So now let's see how these big themes played out across some specific stocks and what's brewing on the global stage. And it wasn't all about Google and Apple. There were some other really big movers today. You had NuScale Power, which jumped 9% after signing a huge nuclear deal, the largest ever in the US, actually. Then there's Macy's, which just soared 20% after reporting surprisingly strong earnings. That's giving some folks a little glimmer of hope for the retail sector. But, there was caution out there too, with some analysts warning that Broadcom's valuation looks a little risky ahead of its earnings report. Okay, now this is really, really critical to understand. While the US market was basically having a party celebrating the prospect of rate cuts, major storm clouds are gathering overseas. You've got government bond markets from the UK all the way to Japan that are flashing serious warning signs. US tariff policy is still a complete wild card, driving up inflation worries. And of course, China's tech giants are still scrambling to get their hands on NVIDIA's AI chips. There's a lot going on out there. So what does all of that boil down to? It means that global investors are getting really nervous about government debt. They're worried that inflation is going to make a big comeback. And because of that, they're starting to lose faith in government bonds as that super safe place to park your money. And when that happens, well, that's a recipe for some serious instability down the road. All right, we've covered a lot of ground today, haven't we? We had the massive Google verdict, the jobs market shock, and this growing anxiety bubbling up around the globe. So, what's the one thing you should be watching now? What's the final takeaway? It really all comes down to this one big question. Right now, the US market seems to have tunnel vision. It's focused on one thing and one thing only. The Fed is about to start cutting interest rates. But while everyone is looking over there, could we be missing the bigger risk? Is it possible that the real threat to this market rally isn't in the US at all, but is actually building up silently in those unstable bond markets around the world? That's something to think about.